Hello and welcome to this Baillie Gifford event entitled Harnessing Growth in an Ever-Changing World. I'm Richard Lander of Citywire and I'll be your host today. I'm joined by Spencer Adair, who's the manager of the Baillie Gifford Monks Investment Trust. So a warm welcome, Spencer. Thank you for joining us. So the drill is I'm going to be talking to Spencer for around 40 minutes and then we'll be taking your questions. So Spencer, newly elevated to the prime manager position on the trust, and the trust also has a new chairman. So lots of change happening there. Is the investment approach changing as well?
Well, first I have to say it's a real honour to be the manager of Monks. I feel a great pride and responsibility for the role. Second, Charles Plowden, the previous manager, and James Ferguson, the previous chair, have left our trust in remarkably good shape. It has a clear identity, a really strong track record, a constructive board, it's growing and it's driving down costs. So, of course, there are always things we can do better, but we don't need to radically change the strategic direction of Monks. Excellent. And then third, running Monks is a very much a collective effort. So we're plugged deep into the expert teams around Baillie Gifford, and that ensures one person's view doesn't dominate. So it's very much a team approach. So the short answer to is the investment approach changing is no, categorically no.
Excellent. So, as you alluded, Monks is one of several growth trusts in the Baillie Gifford stable, and I think for a lot of investors, the question is, how does it differ? How does it fit in within that stable of growth-oriented trusts?
Okay, so Monks and its Baillie Gifford peers are sisters, and we share a lot of the same DNA, but we're also quite different from each other. And you do not want to confuse two sisters. So where we overlap, where the DNA is similar, we're all very long term. We're focused on primarily capital growth, driven by the growth of the underlying profits in our holdings. We're all very much long term focused. Other fund managers get distracted by reacting to every trend or rumor. We see the role at Baillie Gifford is relatively simple. Identify and then patiently own great businesses. But there are also some critical differences. So one difference is that Monks has the broadest remit of all the Baillie Gifford trusts. We can invest in any country worldwide. We're not limited by particular geography, such as Japan or the UK. And we can invest in any size of company we want, from small and private to some of the very largest listed companies on the world stock markets. We tend to have a flatter portfolio than some of our sisters. So the top 10 in Monks historically has been about a fifth of the fund, and the top 10 at Scottish Mortgage would be about half of that fund. So you see there's a difference in concentration. And then finally, we define growth a bit more broadly. Now, we absolutely share the same excitement over the rapid innovators that Scottish Mortgage or Edinburgh Worldwide are backing. But that only accounts for about half of what Monks stands for. These rapid innovators are also blended with steadier, get-rich slowly compounding machines, and also the 3 steps forward, 1 step back cyclical growth companies, or even the deeply out of favor latent growth stocks. So our growth definition is broader, and our portfolio tends to be a bit flatter.
Excellent. But obviously there's a lot that's quite shared with these other trusts in terms of ideas and approach. How does that percolate from the bigger Baillie Gifford house into your trust?
Yeah, so Monks is very much sitting at the heart of Baillie Gifford, and we see our role as drawing the best ideas from every single team in the office. And to help us do that, we have a network of dedicated scouts in each of the specialist teams around the office. Now, these are typically very senior people. They're often our best people. They're all very long-term fundamental business analysts. And they've got personal investment records of tremendous success. And it's this network which forms a large part of our competitive advantage. So they are able to identify a really interesting idea from their area. Say, I've said a Chinese car company, and we can then take that idea and say, okay, this might be China's best car company, But how does that compare to BMW or Mercedes from Europe? How does it compare to Tesla in the US or Tata in India or Toyota from Japan? And so we can take those individual ideas and from their region or from their area and then see how they stack up against the rest of the world. Now, we meet formally once a month, and as that part of that process, we want to ensure that we can hear any bad news quickly. So we say to them, look, what are the 5 stocks that you would buy tomorrow and sell tomorrow should you suddenly become the manager? And we're trying to force them to highlight any mistakes that they think we're making. That's a fabulous risk control. To have talented, experienced people thinking hard about the portfolio every month and saying, here are the changes I would make, that really helps point out things that we may be missing.
Right, and this isn't just a thing within your offices at Edinburgh or where everyone's dialing in from at the moment. This goes deep. It goes worldwide as well. Yes,
so we have our US Scout is based in the US. Our China Scout is based in China. The only difficulty is getting a time that suits everybody. So I have to absolutely commend how late our colleagues in China work, because they've gone above and beyond the call in order to make sure that they're contributing very fully to this conversation.
Oh, well, at least they can do it from the comfort of their own home at the moment, I guess.
That's true.
So one of the things that you publish every year is called the Research Agenda. And it's, I've got the latest one here. It's a very learned and scholarly document. What role does this agenda play for you in determining the investment approach of the Trust?
Yeah, so just to reiterate, we are resolutely bottom-up and stock-focused in our approach. The research agenda is a kind of a live working document. We tend to publish it once a year, normally January, February time. And it's a framework to help guide where we should be hunting for unrecognized growth opportunities. It also suggests where the portfolio requires greater scrutiny. It's really a list of known unknowns. Things that we think it'll be really important to develop our thoughts on, but where we don't have all the answers today. It's areas we want to spend time reflecting on, trying to make progress, speaking, maybe a list of people we want to speak to, from visionaries, academics, journalists, regulators, authors. These are often areas where we see the potential for change being very great, but we've got lots of uncertainty around it, and the change may not be fully anticipated. Now, such seismic changes clearly don't fit into neat calendar years, and hence our research agendas are iterative over the years. We don't aim to conclude our thinking within 12 months, but simply to develop the thinking in that area. And that means that in the future, we prepare ourselves to consider future possibilities a bit more fully and to anticipate and put into context meaningful developments. So rather than reacting, it helps us get ahead of events. Now, of course, over the course of last year, the global pandemic accelerated many of the trends and shifts that were the subject of previous research agendas. And some of the examples there might be the rising importance of data in healthcare, the ability to see people remotely rather than go to the doctor's office, the increasingly infrastructure-like nature of the large technology platforms, such as we're using today for this call, and the superiority of software tools built specifically for the cloud, which can operate globally. So each of these topics have helped focus our research, deepen conviction, and ultimately shape the Monk's portfolio. We certainly didn't see the pandemic coming, but it was that accumulated knowledge over many years of the research agenda which meant that we were actually very well positioned.
Right. I mean, you just mentioned there that the agenda is known unknowns or unknown unknowns, depending how you want to phrase that. So how can you really plot an investment approach with a great deal of certainty if, as you admit, you don't know the answers to some of these unknowns?
Well, I think if something is certain, you're never going to make any money from it, because if it's certain to you and obvious, it's certain to everybody else. If you only stick with the knowns, if we're going to use this Rumsfeld nomenclature, I think you'll never really succeed as an investor. The known and the obvious get priced in really quite efficiently. It's in the uncertain, in the emerging areas where insight's easiest to find. It's a contradiction, but it's actually in the shadows where insight shines brightest. One thing that we note is that there is often a big discrepancy, though, between knowledge, locked areas of knowledge. So often academics and authors understand change much earlier than us financial types. And so that the stock market participants tend to wait until a breakthrough is about to produce revenue, and then they start to really think about it. While scientists in particular focus on the kind of the deep technological advances. So if I take us an example from a few weeks ago, I had the honor of spending a bit of time with some of the pioneers behind quantum computing. And it's still almost have sleepless nights about it, because this changes everything that we thought about many industries. What you currently think of as too hard to even start to tackle will get solved in seconds. And those are massive implications from everything from cybersecurity, product design, climate change, industrial batteries. I am sure that quantum computing and getting our heads around that will be a topic for the 2022 research agenda.
So this was sorry, I was just going to say this was a meeting a few weeks ago that changed your mind or helped you accelerate how fast you think the trends are going to happen.
Yeah, exactly. And because you approach this by saying, I don't know the answers, and you've got that student mindset, I think you're much more open to really listening hard to what particularly some of the academics are telling you. And that's, you're not going in pretending you know everything, which we certainly don't. And I think that's extremely helpful. A second example, which I wasn't actually planning to talk about, but I gave a copy of that research agenda to a group of journalists maybe a month ago, and they came back and read it and corrected my grammar and those kind of things. And they said, look, actually, here is an individual and indeed a family that you really need to talk to. This is someone that could really help you in your thinking in one of these areas of our research agenda. So, I mean, this is how we use the research agenda to really help build out that network, because it's a way of untrapping knowledge that otherwise we wouldn't have got to.
Okay, and we had another one in the research agenda this year is energy transition, and we just had really literally today, the International Energy Agency came out and said basically all new carbon exploration has got to stop if we want any chance of getting to carbon neutral by 2050, which is a big thing for the IEA, often seen as a voice of the oil and gas industry. Is this another big inflection change, do you think?
Yeah, so that's one of our big topics, and that we are literally dealing with something which will take 80 years to really get on top of. Certainly, the next 10 to 30 years are crucial, but we're actually looking at an 80-year topic or theme, and the potential existence of the entire planet is at stake. So I think both in terms of duration and importance of the question, understanding the future direction and what role investment can play and where ideas open up is going to be absolutely critical. So I think that is definitely there. I mentioned that we have these collections of scouts that come together and meet once a month. Our meeting 6 weeks ago was actually on this topic, and we had spent the previous 2 months reading up on different books, going into different industries, understanding a whole range of different items. So this is an area where we are absolutely focused today to understand what it implies. We do start with the very fortunate position of owning very, very few, in fact, one older style in energy company. So we are almost fossil fuel free, and that's a great strength to start from, and then we can then plot forward how we want to, if we can identify and how we want to back some of the newer projects.
Okay. Your predecessor, Charles Plowden, talked of a near future where, as he put it, nearly every company will be a technology company of sorts, or it won't exist. Is that happening more quickly than perhaps Charles thought when he wrote that?
Well, this is getting slightly into semantics, but I think every company today, say, uses electricity or artificial light or email, and these were once regarded as the technology companies. So today, whenever we use the shortcut term technology companies, what Charles is referring to there and what is commonly referred to are data-driven companies. I think it's inconceivable that any forward-looking company, any survivor, won't choose to use data it has to provide its customers with better products or to improve its own decision making. So yes, every company that wants to survive will become a data-driven company. Where I differ slightly from Charles is I think society's definition of what constitutes a technology company will also change and evolve. And within 5 years, it may well be artificial intelligence or quantum computing are the defining aspects of technology companies. And therefore, there will be simply a different group of companies called that. But that's, I agree with his contention. I have a slight correction on the semantics.
Right. Okay. The gap between your agendas, 2020 to 21, was obviously covered by the pandemic. Do you think there are any changes between those two agendas that were accelerated by the pandemic or caused you to say, no, that's not going to happen? Did it change your long-term views on the major trends that we're going through?
So the short answer is yes. I think, of course, some things that we simply put up with because we had to, and I cannot wait to travel again and eat in a restaurant and see my friends and family in person rather than under an umbrella in a park. However, I think there are some structural shifts that feel very permanent. If I could highlight a few off the top of my head, one would be the rising importance of data within healthcare. You look at what Moderna achieved. They analyzed the virus and produced the prototype vaccine within 48 hours using a very data and intelligent design system. That's just one of the vaccines. That strikes me as, and then that is radical. I mean, you're talking about, and I know there's a crisis, therefore there's kind of necessity is the mother of invention, but it strikes me that many areas of vaccine and drug design could be greatly improved by using data, intelligent design. The robustness of having your software hosted in the cloud is absolutely key. We went. I think we were sent home from Baillie Gifford on a Thursday, and Friday morning we were all working absolutely perfectly with our laptops. If we didn't have everything in the cloud and functioning and all the security, then that wouldn't have happened. And so any company which hadn't adopted that has been forced to. I think it's also clear the role of a founder or a family being in charge of a company is really critical. So a company who's able to define what it's for, who looks after its staff in the right way, I think that'll hints that the pandemic's going to lead to a slightly softer form of capitalism, a slightly more inclusive form of capitalism, as opposed to the profit at the only thing that matters is profit. So I think that's an interesting change, and they all accelerated, and they feel really structural. Some of the things which we had been exploring, which feel less important now, would be some of the reasons behind the rise of populism in politics, some of the trade wars. I mean, they may well all come back, but right now they don't feel so pressing. So we're prepared if they come back. We have already some reasonable frameworks and thoughts there, but they're no longer top of our agenda.
Right, okay. We've talked a lot about trends that are going faster or slower, but maybe 5 or 10 years out. More short term, as we speak, we seem to be in the middle of a great rotation from growth to value. This has been going on for a few months. Hopes that the pandemic will end at some point soon, and all those stocks that were beaten down in finance and travel and so on are coming back. As growth investors, does that worry you or change your thinking in any shape or form?
Okay, so there's a couple of bits to your question, if I could tease them apart. So the first is that rotations happen periodically. I think it's healthy for the overall ecosystem to let a bit of the speculative pressure out of whenever it's been building up. So if we study the patterns of our largest winners over 10, 20, 30 years, whatever, you see that routine, common, regular falls of 20%, 30%, 50%, that's normal. So rotations happen, they're normal, they're healthy. It's a way to reset. So as long as the fundamentals come through in the long term, we're just fine. We don't worry too much about short-term noise and what happens to be fashionable. I'll also remind you that Monks is currently 50% the very rapid growth stocks which have been very much in favor, but also 50% in that range of steadier or more cyclical or latent growth companies. And that flexibility in our approach has allowed us to buy some, and this is going back over the last 18 months, we've been buying some really great structural growth companies when they're down on their luck. So we bought several transport-related, operationally geared businesses at the nadir of the lockdown. From Ryanair, Wizz Air in airlines, Booking.com, an online travel agency, and Lyft in ride-hailing. And more controversially, we even bought shares in some of the metals and mining companies such as BHP and Rio Tinto. And we didn't buy these because they may have looked like value stocks or because we're expecting a sudden rotation. I mean, that was genuinely zero on our list. We bought them because we thought there's a decent chance of serious share price growth over the next 5 to 10 years. So for me, it's actually a bit annoying that they've gone up in the short term because it robs us of that chance to allocate more capital to them. Now, the second part of your question is one of kind of growth versus value, and do they kind of do they come together, and are they opposites, yin and yang type thing? I think many areas of modern life have become polarized. In Scotland, one's either in favour of independence or you're a unionist. In Britain and America, politics are either blue or red. That applies to football teams too in certain cities. One is either woke or born before 1990, according to my children. So I think there's lots of people try to introduce that polarization when it comes to investing. But yet wealth creation follows growth models. If you want a plant to grow, got into gardening during lockdown. So if I want my tomatoes to grow, they need light, they need water, and they need the right balance of nutrients. It's not or, it's and. They need all three of those to come together. And for me, growth and value are the same. One simply cannot work out the true value of a company without understanding its future growth. And one cannot work out the true growth of a company without understanding if it creates any value. So I don't see this as some kind of head-to-head debate. If you want to own one of the very small number of really exceptional companies in the long term, they need to grow and they need to create value. Both are required. Now, I think with these shorter term questions on rotations, I think there's a couple of dangers. And I think it's probably just worth, if you give me a couple of minutes, to highlighting what maybe some of these dangers are. First, I think it's dangerous to only drive when you look in the rear view mirror. Just because a company has been growing doesn't guarantee it will do so in the future. Just because a company trades on a low PE of profits doesn't tell you anything if those profits will exist. In an era of really radical change, historic growth rates and low price earnings ratios are very dangerous. They tell you nothing about the future. In an era of radical change and disruption, you have to try to look out of the windscreen rather than the rearview mirror. Even if that windscreen's a bit muddy and you can't get a perfect glimpse of the future. So I know it's really hard, but we try to sketch out different scenarios of what the world might look like in 5 and 10 years' time. And that really helps us to focus on what's important. So yes, there are some beaten up stocks that are having a bounce today, and that's understandable. But unless we see a 5 to 10 year future for them, we don't want to touch them. And the oil companies have been rallying the last few months because the oil prices more or less doubled, as people are expecting us all to drive a bit more and go and see loved ones in different parts of the country. But as you just mentioned with the International Energy Organization, if we're really now entering kind of liquidation mode and we're going to stop exploring for new carbon heavy sources of energy, these companies have got a very limited future. So why on earth would I want to put the shareholders of Monk's capital into something which I think may be doomed in the long term, but has had a small pickup in the short term?
Right. Okay. So think long term. I mean, and talking of which, there's lots of industries, entertainment and reading and music and shopping have been hugely disrupted in the last 10 years in ways that we couldn't have dreamt of. Which industries do you think that haven't really had their cheese moved much yet are next in line?
Okay. So I think there's quite a lot actually. And why I pause a little bit is that I think many of the ones that are next in line have got significant social or political consequences. And so I can see the potential and products that might do this, but I'm a little worried that society mightn't allow these to happen. I think if you look at you mentioned kind of healthcare, I think this concept that you actually physically go and see a doctor every time rather than just do a kind of a telemedicine consultation. Telemedicine isn't perfect, but solves a lot of the problems around infections, etc. So we own both America and China's largest telemedicine companies, and they're making really terrific progress. That could really disrupt primary healthcare. In education, we own a company called Chegg in the US, which is one of the leading online education providers for students, proven to be absolutely critical as schools were shut and universities were shut. I can see many of those tools, expanding, and it's a way to really widen access to education as opposed to your physical location. That feels like a good thing to do. We've mentioned energy disruptions just starting there. Be very, very careful. Watch this space. Also, law enforcement. One of the companies we own, Axon, have those body cameras that police wear, and also the taser, non-lethal weapons. Those could really radically alter law enforcement, particularly in countries which have where the trust in the police perhaps moved relatively low. And probably the largest though area with banks and insurance. We see a variety of fintech upstarts coming along, some of which we own, many of which we're still trying to examine due diligence on. The losers though are the largest banks and the largest insurance companies. We need to really think very seriously about why they might survive. I've been gaining some inspiration from trying to think about which areas will never be disrupted. And never is a very dangerous word in investment, but which areas are very unlikely to be disrupted. And I've been trying to gain some inspiration from archaeologists. And whenever you see a Roman villa being uncovered or an Egyptian tomb, I try to see, well, what products were there that actually are more or less unchanged today? maybe several thousand years, what do we still see that are the cockroaches, the things which survive the nuclear attacks? And there are a few of them in the portfolio. So there was an Egyptian tomb opened from 3000 BC, and they found a little jar of scented moisturizer. And in the portfolio today, we have Estee Lauder for skincare and cosmetics. And I think the desire for vanity, or at least the desire not to age so quickly, are pretty timeless. There was also in one of the Chinese river deltas, they discovered from 7000 BC, they discovered a kind of a bowl that had fermented honey, grapes, and rice in it. And they think that this was the basis of an alcoholic drink. And again, in the portfolio, we have Pernod Ricard, a little Dutch courage helps social situations, and has done for 9,000 years. I think it appears that we needed booze as a species before we needed makeup, and there's some wisdom in there. So there's some things which are genuinely cockroach-like, and that they will survive. And there's other very basic materials companies that we don't see being kind of innovated away by technology. But the vast majority of commerce, we would see it as at risk of disruption, and therefore you have to make sure you're on the right side of history.
Right.
So that's one of the things that we try to do.
So, and a lot of these disruptors obviously start out as private companies, and you've got some enlisted investments in your portfolio. How do you find those, and what different role are they playing from the listed stocks?
Yeah, so we're enthusiastic about our unlisted investments. There are a number of factors there. Firstly, we have a great internal team. I think that collection of individuals are really one of our most talented and highest potential teams we have. So it's good to back them and get close to them. We get privileged access because of our size and reputation as a firm, and that means that we get to speak to some of the people creating tomorrow, and we get to have long conversations with them. I mentioned the quantum computing guys. Sometimes those conversations blow my mind, and I have to go and lie down in a cold room. There's a flying car company I remember that I met out in California, and I still can't quite work out if this is science fiction or reality. Companies are staying private for longer, and they appear to value our ability to own shares both privately and in public markets. And in Monks and in some of the other investment trusts, those are ideal vehicles that allow that kind of that kind of transfer of across the listing boundary. So in keeping with the emphasis on diversification within Monks, we get the vast majority of our unlisted exposure through a diversified fund also run by Baillie Gifford called the Schiehallion Fund. And I would expect over time the Schiehallion Fund will become Monks' largest individual holding. And then we will have a small number, a handful, say, of direct holdings in the most exciting later stage private companies.
Okay. I've asked enough, and I've got a ton of questions from viewers because I think we've got a huge number of viewers out there. So I'll try and group them together. There's a number that have fascinated, as I was, by your mentioning of quantum computing. And a couple are saying, how do you propose to invest in there? Do you go to, the big companies like Alphabet or IBM that have got quantum investing interests amongst 1,000 other things they do, or do you go for the minnows, for the specialists who are breaking new ground here, and that's all they do?
Yeah. So we've already got exposure in the portfolio. We already own several large tech giants, and part of those investment cases are that they are always trying to innovate and create the future. So we look at Google, Microsoft, Alibaba, Tencent, and they are all in different ways exploring quantum computing. However, it's tiny. It is a drop in a very large ocean of a large company. So, of course, that is a starting point for us to learn. We've already got some a network built up. I would love to find an early leader in this field. There are very few that are listed. It's probably going to have to be via a private route, and that's fine. We are unlikely to get the very first one right. So you use this as a stepping stone to understand what's really happening and what's really going on. So look, we are at our early stages of development. Some of my colleagues in different trusts are closer to one or two of the companies than I am, but this is an area of continued importance. As well as so there's two things. You can first, how are we going to directly get access to it? But secondly, make sure you fully understand the implications for all of the other listed companies. If you have a company that today depends on cyber security or that can be cracked within seconds. That has got huge implications for many of our businesses. So we want to spend a bit of time thinking through that. Where could quantum computing, if it comes in 5 or 10 years, where could it really alter the competitive dynamics within industries? It's literally mind-blowing. I mean, I kind of left that meeting. I wasn't prepared to invest directly, but I was just thinking this is a real game changer, and we need to rethink many of our assumptions. If we didn't have a fantastic network of academics and private companies, we wouldn't be having those conversations.
Right. And how often does your mind get blown by a conversation like that? Once a year, more than once a year?
No, I'd say once or twice, once a year on average. I'd say something happens, and I can tell because I stopped writing. I stopped taking notes. I can't even, I think almost by moving my hand on the page, I'm somehow interrupting the individual, and I just talk to me. And then I have to go and try to sit in the room afterwards and recall roughly what was said. So it happens, it's periodic, and it's radical. And there are, there is a world of accelerating change and growth from technology, and this is one example. There are many others, and it changes everything. And you can't keep looking in that rear view mirror about how you invest. You have to try to sketch forward. Of course, we don't have all the answers in quantum, but we can at least start to have a very approximate map about what may happen first or next.
Okay, move on. Someone saying, I'm fascinated by all your discussions with academics, and you've obviously got great privileged access to some very clever people. Do you have any recommendations for an ordinary investor like me? Any blogs or websites I should be viewing to keep myself up with these developments?
Well, firstly, I'd get on Twitter. I think an amazing number of very talented people share their views on Twitter. And there's a lot of rubbish on there too, of course. But I think if you can curate the people that you follow there, you can really get some fantastic resources. One source I find particularly helpful in the last couple of years is Farnham Street, which is a resource which has helped me greatly with the mental models and understanding different ways of thinking about the world. And that's just such a broad topic. It almost anybody can start there and then start to go off in different directions. And, so you will have your.
What was the name of that?
It's called Farnham Street. Farnham Street.
Farnham Street. Good. I think that would be useful for a lot of people. Another question, and you touched on this with the oil price and your investments in mining companies. Do you believe a commodity super cycle has started, and how is this affecting your remit or indeed your investment approach?
I'm not sure about a broad commodity super cycle, but the reasons behind us getting quite excited about BHP and Rio Tinto were firstly, new mining capex really peaked in 2013-14. So we have had 6 or 7 years of a bit of a capex freeze. At the same time, we see rising structural demand for many of these commodities. If you think about how we have to change with the electrification of many things such as cars, etc. Demand for copper, for lightweight aluminium, even for steel in terms of the infrastructure behind wind turbines, etc. I can see a demand shock coming, and I see an existing supply shortage, and that was there even before, even during the pandemic when demand wasn't very high. I can absolutely see an extended period of shortages and higher prices, particularly in those metals and materials which help us transition from a fossil fuel to a low carbon economy. That's the real sweet spot for me.
Right. Yeah, and I think a lot of us perhaps don't appreciate that. Transitioning to new energy means digging up a lot of old stuff like iron ore out of the ground. Yeah. How do you do that without making the energy cycle worse? Because they are very labour and capital and energy intensive industries.
But this is a conundrum I don't have the answer to. I think, and this is where there are certain metals and minerals where it's easier. So what is the carbon intensity of extracting that material? Is it used once, or is it used for the long term? So you can recycle a lot of your copper, for example. Or is it like coal, which you burn it and use up and it's gone the next day, and it's gone, you have to do it again. So there's a duration element of it. Many of the and again, this is very early thinking, but if you look at something simple like aluminium, aluminium smelting takes up a huge amount of electricity and therefore can be very pollutive. And this is not something that we have implemented yet in the portfolio, so it's forward thinking that I haven't concluded on yet. But we can observe that in several countries around the world, it's essentially coal is burnt to smelt aluminium, and that is extremely polluting. Now, whenever we start to price in carbon properly, the price of aluminium in those countries soars. But yet in other countries, Iceland and Norway, they typically use hydro power to smelt aluminium. And if you put a carbon price on top of that, their price of aluminium hardly moves. And so you could have, if we start to factor in the pollution, the pollutive event, the true cost of pollution behind any kind of mineral or extraction, you could actually have very big changes in the competitive dynamics between countries and companies. And that's something I want to spend a bit of time exploring, because that it feels like a solution, and it feels like steering us towards lower carbon approaches. But some countries and companies are already there with an advantage. Now, they did it because they had cheap hydro, but so be it. We'll take it. We'll take a quirk of history as an advantage.
So, short answer, it's pretty complicated. Moving on to the next question. Someone asked, does the fact that private capital markets in Europe are less developed than the US give you an opportunity to make such private investments in Europe? Is it less efficient? Is that an example of a less efficient market that you can latch onto?
Yes, and I think there are several hubs within Europe that are developing for both technology and private companies. I think, and we're seeing several leaders in this area. So I think there's a collection of businesses around Berlin that are really, really exciting. There is a collection of companies who have perhaps pivoted from a more traditional operation towards one of a forward-looking. I would look at, say, Schibsted in Norway, which started off and has got a very long and established history as a newspaper business, a media business. And it must be 25 years ago now, approximately, they started to say, well, look, what's in the back of our newspapers? We might be able to digitize some of this. So, let's digitize the classifieds operations, etc. That you got in the back of the organization. Now that company has continued with its newspaper operations, but has grown and fostered hugely successful businesses around Europe by being able to pivot and essentially let them grow up as a kind of almost a private company protected by a listed umbrella, and that's been extremely successful. So, and that's one of our holdings, and that it looks like they've got a next division which they're trying to do exactly the same thing and reinvest. So European capitalism is different to American capitalism. It doesn't mean it's worse. I think it's probably more sustainable, and as we approach private investments in Europe, we have to be aware of those different types of flavors. European companies in general are a bit more aware of their social responsibilities. It's a gross exaggeration, of course, but it's broadly true. And so the conversations we have with European companies it feels more natural than perhaps a really naked form of capitalism.
Okay.
But yeah, I'm really quite excited about what comes out of Europe in the next 20 years.
Excellent. Got time for one more question, and I guess this comes back to the conversations you have with academics and outsiders, and perhaps these are more financial experts rather than technology ones. Are you happy that the banking credits and markets generally, especially in the use of derivatives, are adequately regulated so that we don't see a rerun of 2007, 2008? I guess that's a sort of black swan event, and the things about black swans, you never spot them, but do you have any worries about that?
So I think it's rare that crises repeat exactly. So that would be, we often fear the last crisis. Well, actually, the next one's forming in a different place. So I suspect regulators were once bitten, twice shy when it comes to a lot of these things. Certainly, a lot of the banks' capital bases and indeed the insurance capital bases have structurally become much, much deeper. And so they are better able to withstand. The fact that we didn't have major bank failures during the downturn of last year is a real credit to the system. Specifically on derivatives, the problem I have with derivatives is they often involve natural gearing or leverage, so people can have a much greater exposure than their capacity to pay, and it feels divorced from the real world. So we speak to academics, etc., in order to gain better insight into real world businesses. And so it comes down to, this means this is going to grow faster, or margins will be different, or costs will be different. There's some real world tangible, I can almost point to the factory and say, that's the result of the insight. You can really have that. Whenever people can be trading derivatives, they can get so far divorced from reality that really weird things start to happen. And I think the further you are away from the real world and the more leverage you use, it makes me really quite nervous. So it's, I think, a sense of trust in the regulators, but always that sense of unease that these will be used for speculative purposes and for people that don't fully know what they're doing.
It'll be different next time, as the saying goes. We're going to wrap up there because we're very nearly at the hour. So Spencer, I'd like to thank you very much. I think it's been an absolutely fascinating discussion, and I'd like to thank everybody who's tuned in today. I hope you enjoyed it as much as I did. There will be more Baillie Gifford Investment Trust webinars coming up. It'll be me again, I'm afraid, with a different manager, and I'll be in the CityWire studio each month. So thank you everybody for tuning in. Thank you for your questions. We had, I think it was a record number this time, and I look forward to seeing you again very soon. Spencer, thank you.